integration of technology and financial services is rapidly changing Asia's banking landscape as ownership stakes in banks are taken by big techs and fintech firms and non-bank financial institutions, as well as by incumbent banks. Many new entrants are leveraging social media platforms and applying advanced data analytics. Accordingly, we will be discussing on findings of Bank for International Settlements paper on virtual banking and beyond by Monetary and Economic Department of BIS. Two-thirds of the global population have an account at a financial institution. According to the Global Findex 2017 survey, but only around a quarter or 1.5 billion report saving or setting aside money in those accounts over the past 12 months. Further, just over one-tenth or just 0.6 billion report borrowing money from a financial institution for the same period. This signifies over one-fifth report saving money outside the financial institution over the past year, while 36% report recent borrowing outside financial institutions from other sources such as family and money lenders. This indicates increases in national income lead to an increase in overall savings and borrowings. This demonstrates in terms of access to emergency funds, while the proportion of the population in advanced economies that has insufficient access is lower than in emerging and developing economies. It is 38% versus 63%. It still is nearly two-fifths, which again suggests there is considerable room for greater use of the financial system at all levels of economic development. This displays consumers' digital footprint has expanded as the number of touchpoints have increased dramatically, aided by high-speed internet networks, high network connectivity, and smartphones. This displays impact of development on banking activities can also be traced through the evolution of the bank technology stack, which can accommodate a variety of banking business models. In all of them, greater use of mobile devices and connectivity combined with digital identification, electronic KYC verification, and digital signatures has vastly improved access to the banking system. This illustrates most of these digital banks offer an enhanced digital experience that encompasses other parts of the consumer's lifestyle, including social media and consumption. These are services that are typically not yet available at traditional brick and mortar banks. This denotes measures of access to and demand for digital banking services, as proxied by banking app downloads and the number of users, suggests that there is a growing interest in and greater access to virtual banks. Monthly downloads of major virtual banking apps are accelerating rapidly in Korea and Hong Kong, although measured growth in other jurisdictions has been more muted. This demonstrates big tech and big tech firms are more of the largest shareholders of virtual banks across Asian markets. Song An, a Chinese insurer, co-owns Hong Kong's Day Bank, while investment firm Korea Investment and Securities has a stake in South Korea's Kakao Bank. Also, and Financial taking controlling stakes in one of the approved virtual banks in Singapore, and Singapore's DBS doing the same in India and Indonesia. Although significant progress has been made over the last decade in increasing access to bank accounts, use of the financial system to save and borrow remains low. This is a problem not only for developing countries but for jurisdictions with high level of education and income. Examination of the breadth of activity, diversity of customer demographics, and innovative mixture of ownership structure in virtual banks in Asia suggests that financial inclusion could take an important step forward. Transformational impact of public initiatives is evident in developments in Asia, including Hong Kong. Hong Kong Monetary Authority, or HKMA, has defined a regulatory framework for virtual banks that seeks the benefits of fostering innovation and inclusion, from allowing diverse ownership structures in which big tech or fintech companies as well as non-bank financial institutions can take controlling stakes. Data-based credit allocation might diminish the value of relationships between borrowers and their bankers, while virtual banks are likely to lead the way in this technological transformation. Incumbent banks will seek to manage the burden of their IT legacy systems and complex organizational structures to close the gap. Ideally, when granted control of their own data, consumers will be able to choose from the best of both worlds. Today's presentation is based on BI's paper titled as Virtual Banking and Beyond. Thanks for watching.